We are back, and we're diving into crypto again, but this time with a 2025 lens. Is it a hedge, a bet, a political statement? Maybe all three. Leading this discussion is someone who sits at the intersection of blockchain and traditional finance and isn't afraid to challenge the obvious. Please welcome our moderator, Andrey Stoychev, CEO of VS Capital. Gentlemen, the floor is yours.
Thank you. Thank you for the intro. Welcome to our panel today. Thank you for the invitation once again, the whole IFX team for the organization and everything. Happy to see my friends here at the panel. Before we start really discussing about if crypto is really a hedge, or what exactly is where we can find crypto in the traditional finance, in the regulation these days, especially this year. It's a really interesting year about the crypto regulations. Let's first take a minute or two to introduce yourselves, and then we can start deep dig.
Okay, thanks again to the organizers as well for inviting us another year here. My name is Andreas. I'm the Community Operations Manager at BitGet. BitGet, for those who are not aware, is a top crypto exchange globally. We're actually the second biggest exchange in number of users. So yeah, it's great to be here again. Thank you.
I'm Tom Higgins, and I'm CEO and founder of Goldeye. We're a technology company that's been around for 17 years, so a long time. I think I've been to all of the shows here, so I know everybody. I know this space very, very well. But about 8 years ago, we got very interested in the crypto market, and so we pivoted our technology stack into institutional cryptos as well as FX and CFDs. So we provide three solutions that address the market. The first one is liquidity management, which covers gathering liquidity from all of the different sources in FX, CFDs, exchanges, market makers, ECNs, and then work with prime brokers like Hidden Road and LTP. And then we have money management software as well as then risk management software. Thank you.
Awesome. So my name is Anton Golub. It's a pleasure to be here, and thank you for the organizers to organizing such a nice panel and inviting me. I've been in the crypto industry for more than 10 years, so part of this early group of pioneers in Switzerland that built some of the first crypto companies. Today I'm leading Freedx as a chief business officer. Freedx is a UAE headquartered crypto exchange, both for newcomers, newbies to enter into the crypto space, but also for professional traders.
Thank you, guys. Thank you. Appreciate. Okay, so obviously really good professionals here, knowledgeable guys for both crypto and traditional finance. And this year really big volatility in the traditional finance, all these different assets. Also in the crypto, it's an interesting year because of different political and not only political things. But straight to the point, is really a crypto hedge for the brokers or for the investors? So what exactly you think about this, Tom?
So it depends what you mean by hedge.
It really depends. But
that term is used very strangely in retail and institutional. I can read it in two ways. I can read it as, is it used, do you use it instead of running to gold, you run to crypto, you run to Bitcoin to put your money in because it's a safe place to go. Or you could read it as, if the markets are not active enough in FX and CFDs and you want to get more client activity, do you then add a digital asset so that you've got more to hedge your and diversify your income as a broker? I think it applies to both, actually.
Or maybe you can use crypto as a hedge of alternative way to attract more clients, more users, more traders,
I think absolutely. I mean, to me, it sits in the same camp as sort of gold and silver and indices. It's a volatile product that if you're in the top big coins, it's not insanely volatile most of the time, but then the indexes and Tesla can be incredibly volatile. It's manageable volatility. Now, some of the meme coins and the ones lower down with weird names are very different. But absolutely, and I think it serves just an absolute purpose in providing an additional asset for all retail and professional traders to play in, because why would you not? It's volatile enough to be interesting, it's growing, it's got a lot of interest, so it fits all of the criteria.
Okay, so what do you think about it?
So reflecting on the last 10 years, I first want to say is that today, crypto is a separate and an established asset class. So that's kind of like the first point. What I mean by that, if you look at the total market cap of all the cryptocurrencies and tokens, which is predominantly Bitcoin, Ethereum, and a couple of other ones, it's actually several $1 trillion. And just to reflect on that, when I started my journey in crypto, the whole market cap of cryptocurrencies was 1 billion. And today it's more, a couple of trillion. So it's a separate established asset class. And separate, by that I mean is that if you look at the correlation of the price returns in the crypto industry, or let's say Bitcoin against all the other classes, you will find that the correlation is very low. So that's what I mean that it's actually a separate asset class. And again, separate asset class from perspective that today you have infrastructure that is very different than in traditional finance that enables you to invest into crypto classes. That can either be that you buy it through a crypto exchange, you go like for instance to Bitget, Coinbase, Binance, or so on. You go through one of the brokers, right, to get the exposure to maybe a synthetic instrument. You can buy cryptocurrencies or tokens through DeFi, so the decentralized finance protocols. You can buy today through ETFs. And maybe even to be a bit more forward-looking, you today also get exposure through volatility products like strategy and also all these other products where you're building a treasury company, right? So the reals are there, the infrastructure there, the returns are there as well, meaning that if you were part of the crypto industry for the last 10 years, you benefited heavily if you didn't sell all this, right? And I agree with you, it has also some specifics. The crypto industry is, for instance, highly volatile by nature, right? You have these all big ups and downs. You have the cycles that last 4 years approximately. You also have something called halving, right? So as Bitcoin gets mined, you get less and less of it. So it has its own specifics. So I would really say unestablished and separate asset class.
Okay, no, make totally sense. Andreas, I was thinking while Anton was sharing his thoughts that, we are, more of us here, we know the things from the Forex and traditional finance perspective. But, okay, you are purely offering a crypto solutions to your clients. Do you think that, or can you tell us a little bit more about if these clients are looking for traditional assets or they consider vice versa, you know? We are now speaking about crypto is a hedge from perspective. I'm trading gold, then I will trade, and I hedge myself to trade Bitcoin, or I will use Bitcoin to attract more clients. But do you think from your perspective and your company is doing vice versa? What do you think, and how you consider your clients basically?
Yeah, so to answer also your previous question, I think we can by definition see crypto as hedge, like the definition of hedge to traditional financing. As Anton said, there is low correlation. It's a completely different asset class, and crypto is much more than just an investment. It has so many use cases on DeFi, on NFTs, or even on mint coins. It's a different use case. So what is, let's say, somehow mimicking the traditional finance and even improving it is, providing an alternative payment mechanism. I mean, Bitcoin can be seen as an alternative payment token, let's say, to traditional finance. Crypto is mimicking also, traditional finance by exchanges can provide like interest rates, like higher interest rates than usual than traditional financing is doing. In some occasions, exchanges provide crypto loans, or even in DeFi you can acquire a crypto loan. So there are so many use cases, different use cases that crypto can provide that can be more efficient, more fast, less costly to traditional finance. And I think this is where the attraction point is for the newcomers. They want to see why should I just keep my money in the bank? Why can't I stake it on USDT or on USDC and enjoy a higher interest rate, let's say? Why can't I use it? Why if I have a son or a daughter who is studying abroad, why should I? Why don't I send them crypto straight within minutes or within seconds to fund their activities, to fund their studies, and wait for the traditional banking, which may ask me questions, it may raise concerns, it may raise blocks, it may delays. So I think this is where what the people see in crypto, and especially I think stablecoins is also a big factor right now. We've seen the Genius Act being established in USA like these days. So if you ask Trump and all those guys like 4 or 5 years ago, they would say, okay, crypto is a scam, or no, I don't want to use other words that they said. But right now you see that everyone is embracing. US is adding crypto reserves, and I think we're heading to the right direction.
Can I just challenge that it's a completely different thing? Because I think if you go back to the original ideals of when it was invented, of getting rid of banking so the unbanked could exist and not have to KYC and not be shut out of banking, they shouldn't be, to what it is today is really, I was just thinking about an analogy that might work, is a restaurant. So in a restaurant, they're going to give you a plate of food. And all of the sources of the different things on that plate will come in completely different ways, if it's coming from meat, vegetables, fish, fruit, whatever. And you don't really mind, you don't really care where all that bit happens. The fact that it all gets put together in one place and served to you is what matters to you.
Depends who is asking. If you ask my wife, she's more careful. Depends who is asking. But yes, in general, yes.
So what I mean there is, as a broker who has clients, sure, you want to offer them all the different asset classes in a single platform. Where it executes, where it gets its liquidity, where it gets its pricing is very specific to each asset class, because like the metals might come from a metals exchange, the FX might come from FX broker, and the cryptos might come from your exchange. But together, I don't think this will work well if it's separated completely. So you have one platform with one screen and one thing that is just cryptos, and every other asset class is treated as outside of cryptos. I think it comes together as one thing.
Yeah, I think, technically it can be done, but there is a lot of regulatory scrutiny, for an exchange or any institution to offer all these kinds of products in one platform. It's very difficult in terms of obtaining the licenses required, to offer all these products.
Well, for an exchange, yes, but for a broker, this is what we do from our tech side, is we allow them to disconnect it all.
Here is my next question specifically for you, Tom, because, companies like yours, where you really invest a lot in the crypto space, so you start bringing the crypto to the traditional finance one way or another, and like us, where, okay, you are from the tech side of the side, we are from the service or liquidity part of the side, but we are somehow improving really what the crypto offering in the traditional finance. Do you think that, and can you tell us your opinion based on your experience, if your clients, if the brokers who are using your technology, let's say, getting more and more excited about the crypto and start investing more and pushing, using marketing campaigns or whatever to attract more clients using the crypto like, selling point or something? Yes. Because from our side we can see exactly this, which is in a way something which is really interesting.
Absolutely, that's the biggest push I would say of new leads for us coming in, is either clients that they're not clients of ours, but they want to use our technology to add cryptos, or existing clients of ours in FX who want to add cryptos as another asset class. Now they will source that liquidity very often from exchanges like yours, or from market makers, or if they're much larger, they would probably aggregate a whole bunch of market makers and use a prime broker. But that's a very institutional game, that's very large. So some will do that and some won't. But very much so, there is this push for them to add this as another asset class, because otherwise, as a broker, how do you compete? If your prices are squeezed anyway, you can't add anything else. How do you get bigger? How do you do something to differentiate? You really adding another asset class is about the main thing you can do.
Exactly, yeah, especially in the crypto, because in the crypto there's a really big gap between the traditional crypto guys and the traditional finance. The two offers to the retail clients are totally different.
Yeah, and at the moment, regulation makes it a bit lumpy at the moment because it's not consistent and it's not there in lots of places. But roll forward a year or two, then when crypto regulation is everywhere, then a broker will very easily be able to do it under their regulatory licenses.
I think my question is, okay, it's, as I said before, technically it's easy also, I believe, but providing the best possible experience to an average crypto user is not just about, in my opinion, it's not just by obtaining liquidity and the appropriate licenses. You need to have like a proper institution in place. Like, I mean, exchanges like us, we have like 2,000 employees in like 70, 80 countries. And we work on, campaigns, we work on community work, we do like hundreds of events each quarter. We do reports, we gather feedback from the users. So you can imagine that 2,000 people worldwide are working for this thing. So then in liquidity also, you're right. I mean, we do collaborate with traditional financial institutions to provide liquidity to them or vice versa, whatever. But I think to provide the great experience to the users, it has to be like coming from an institution which is devoted to this thing and be up to date with all the trends and services that are out there and can be offered to the user.
Okay, yeah. Anton, based on your 10 years of experience in crypto, I hope you still keep some of the crypto, during this.
That's the only thing I keep, yeah.
That's even better. But what do you think? I mean, obviously there are now two types of, let's say, investment platforms. One is purely for crypto. Others are maybe traditional brokers or other providers who are offering not only crypto, but also investing in gold, investing in stocks, investing, speculating.
Yes.
What do you think is best? Obviously it depends, but in general.
So first, I want to point out that these are not going to be in the near future two separate worlds. So this traditional finance and the native crypto Web3 world, they're not going to stay separated for so long, due to a specific reason that one of the biggest trends at the moment in the crypto industry is something called tokenization of real-world assets. So what we're trying to do in the crypto industry is find ways, which are usually legal and regulatory ways, how can you issue an asset of any form directly on the blockchain, and then that token that you then hold gives you all the legal rights or the regulatory protection as you would have in the traditional finance. So I'll give you an example. What does that mean? So for instance, in Dubai, in UAE, we have a very progressive regulator. And for the first time in history, what we did is we tokenized the title deeds of the properties. We put them on a blockchain. This is all approved by the regulators, supported by the government. And you have the ability in the UAE to buy a fraction of top real estate in Dubai. So what practically happens is they bring a property. So they bring a flat onto the platform. They slice it in small pieces. And you can invest for as little as $400, $500 and buy that small fraction of that flat. And you are the owner of that small fraction of that flat. You're entitled to price appreciation if it happens or it doesn't happen. And you're entitled to the yield that comes from renting out the flat because you have a property management company.
Can I put this in a platform to be tradable?
Yes. So
because it's something which is also can be
exactly. So because you can't really easily trade a flat right back and forth between us, right? But you can create tokens,
like shares.
Yeah, like shares. And then you can put it on a platform, then people can trade it, right?
How would you price it then? How would you get a streaming price?
In Dubai, this is not a problem because all the pricing of all real estate, both on a transaction basis, but also on the rental basis, is fully transparent.
So I think you need a market maker for this as well.
Yes. This is, so you can actually find, you cannot find it by my name, but you can find in public records what was the price of the flat that I rented this year. It doesn't say my name, but you can find it there, right? This is all transparent in Dubai. So you have tokenization, you have distribution, you have the clients, you have the marketplace, and then you need the market makers to provide two-sided.
Yeah.
Is this just NFTs with a nicer name?
But the thing is, I don't like to say NFTs because then it either scares the people or it doesn't scare them. So, but I want to also point out, I gave an example that it relates to something we can all understand, which is real estate, right? We all somehow have real estate. We know somebody who has real estate. But you have products in the crypto world that don't exist in traditional finance. It will never exist. And I'll give you one example very quickly. The most successful exchange that has been launched in the last couple of years is called Hyperliquid. Hyperliquid is a self-custodial exchange where you can trade perpetuals on the top cryptocurrencies, and you trade them to something called an automated market maker. I have just said 3 words that don't exist in the traditional finance industry. Self-custody means that I plug in my own wallet onto the exchange and I own the assets. It's not sitting with a bank, it's not sitting with a broker. I own the wallet, I own the assets. This doesn't exist in the traditional finance. Then I said, you're trading perpetuals. Perpetuals are kind of like CFDs, but not. This is a crypto
We
native.
can have a really long debate about this.
But it's a crypto native product.
Yeah.
And then I said you'd have something called an automated market maker that gives you the pricing. So it means it's a transparent formula that actually determines how the pricing of that perpetual moves up and down, right? And it's transparent and you can easily see it. And it's not like the broker moves the price and then he stops you out and you're wondering how did that happen, right? So 3 things that don't exist in the traditional finance. And on top of that, in hyperliquid, if you're a trader and if you trade a lot, you're entitled to part of the revenue share on the exchange. You tell me if New York Stock Exchange or NASDAQ or LSE gives you a revenue share because you're such a big trader there, for a regular person like myself.
Actually, they're charging you for market data usually.
Yes, even for market. But so what I want to say is I think the merger is happening. It's coming, right? We need regulation, we need the laws, we need the governments to enable that.
But the regulation is coming, right? It's all these things will be part of the regulation one way or another, right? Or not really?
Takes time.
DeFi is very hard to regulate.
Takes time, yeah.
I don't know how regulators will regulate DeFi, to be honest, because you don't know who the other side is.
Yes, exactly.
So
On the other side of the...
yeah, they would regulate say, how do I know that the other person isn't a terrorist that you're dealing with? And you can't.
The AML is not that developed. So I make it maybe positive about that.
Okay.
But I even heard
I think this is the right moment to speak about the security and the settlement and everything which is related with the crypto, because this is a really interesting topic that most of the people, as Andreas mentioned, 5 years ago, maybe more, maybe less, okay, it's a scam, it's, you lose your money. Now we are speaking about, keeping your self-custodian, keeping your money with you, basically. So how you consider, for example, your clients, how they are, let's say, trust on your platform to put your money there?
Yeah, I think we're proud to say that because you asked specifically for our platform, BitGet is...
You can...
I mean, we're an exchange that has never had like a security incident, anything like that, and we take some measures to avoid that. So first of all, we have a proof of reserves ratio of 200%, and this is a measure that has been taken after the FTX collapsed by a few exchanges. What does this mean is that for every user asset balance, we have double the amount in our reserves, and this can be transparently proven via blockchain, and we keep these balances in 4 coins, Ethereum, Bitcoin, USDT, and USDC. And this can be verified by any user through our platform.
Super important product.
Yeah. So we prove our reserves and liquidity there, and we also have the so-called protection fund. This is a fund that is amounting currently to 6,500 Bitcoin, so it's well above $1 billion right now. And it's supposed to be used in case of extreme market circumstances. So an example of that is, let's say one of the tokens that has been listed, has been hacked or has been cracked or whatever the case may be. Then we use those funds to compensate our users. Through that fund, we also actually provided an aid of 40,000 ETH to Bybit after the recent hack they had. So even though it's our competitor, we see crypto as a family.
I think the community was super strong at that moment. It was really something which I never saw before. It was really nice. Yeah, just sorry for interrupting.
So we have the fund, we have the pro reserves, and we also like to educate our users a lot through online AMAs, through events. Actually, right now in June 2025 is the anti-scam month for BitGet, and we have several initiatives to help them, understand common security practices, both for centralized exchanges and also if they want to deal their crypto in DeFi world, where they have the custody, as Anton said. And other than that, we have internally the appropriate security measures that we need to, like most of the funds are in cold wallets through multi-sig procedures. So this means that there is no like a single single person who can be compromised or can be malicious and deal maliciously with the assets of the users. We have SSL encryption for eternal transactions. So I think we're a pretty good place, and that's why we haven't had any security incidents so far, and I think we should be able to do that with these practices.
Yeah, thank you for this. It's really, really interesting and really important. And I know that a lot of crypto companies, pure crypto companies, start investing a lot for the security, for this. Okay, you never know what can happen, but still, it's much better than 5 years ago. Anton, what about your company and how you are managing this internally, externally? How you are proceed with this type of security, let's say?
Yeah. So I will just briefly touch upon what Andreas has mentioned, and then I will address different types of risks. But on one side, I mean, every crypto exchange invests enormous amount of money to address technology risks, namely cybersecurity vulnerabilities, right? So in practice, what that means, you hire a professional company that does something called penetration testing, right? So it assesses your platform both from a, let's call it Web 2 perspective, like how does the front end work? Like, can they access the servers? Can they access production code? Can they get root access to your servers, right? So they're trying to understand, can they penetrate the traditional technology, right? But on the same time, they're trying to assess, can they actually penetrate or exploit vulnerabilities in the pure crypto technology, which is your smart contracts, custody, matching engine if it's on the exchange, nodes, right? How do you actually get the data from the blockchain? And that's actually what they're trying to then test. And today you have many, many great companies that are doing that on a quarterly basis. Usually you have a quarterly assessment. This is then provided to the board within the risk committee, and then they assess it and try to make sure that everything is correct or in order, right? And today those are even requirements at the regulatory side. So every regulator will tell you have to do something like
Just to add here something, I guess Tom can confirm as well because of his experience and his clients that, brokers are really sensitive about where sending money, why and how. So they're really careful about this, and their compliance guys are pushing them in the sales and the business developers to be really careful about this, right?
Absolutely.
Yeah, but sorry.
Maybe just to add, but there is a different type of risk actually within the crypto industry, which is kind of, I think you touched upon it in the example of Bybit, is actually human error. So let me just explain to you. So Bybit was the largest hack in the crypto history, I think probably in the history of humanity, right? Now, what did actually there happen is that the hackers, which we now assume are from North Korea, so this Lazarus group, what they did is actually they got root access from a key stakeholder within the technology that this exchange was using. And once they got root access, they actually realized this person even has access to the production code. The actually post-event analysis actually found out that actually they penetrated the servers.
From the very beginning,
yes, it was
like this.
It was so it literally, and then they were running around actually the servers of the exchange, and they actually found out that through a very simple process that happens all the time, which is when you move big sums of cryptos of the exchange, you have something called a multi-sig wallet or a multi-sig procedure, meaning if there's 4 of us here, 3 have to click the button and say, yes, we approve the big transfer. And what did the person do? The hacker do? They actually changed what you see on the device when it says what are you actually doing. So the team members of Bybit, they thought that they were doing a regular transfer out because they actually changed what they show on see on the device. So they literally thought this is a normal transaction, part of the day-to-day business of the exchange. Of course we approve, we don't want to stop the business. But in the background, something else was happening. Yeah. And this resulted in the biggest hack in the history. But when you think about it, this was a Web 2, this was a traditional technology issue. It was a human error because they actually speculate that the person downloaded something from, he thought it was a PDF from one of the social media platforms, but it was a malicious code that they actually then gave access to his servers and production code and even the root access.
Yeah.
Crazy.
Yeah. Yeah. Human error is something you look in cybersecurity because we do quite a lot in cybersecurity. It's something I'm particularly interested in. The human firewall, as it's often known, is nearly always where you get in. It's much harder to hack through, physically hack through firewalls and stuff like that. But it's much easier to send an email out to someone and say, click on this, your picture's on Facebook, and look how silly you look. And they go, oh, they're lovely. So cyber awareness training as a sort of thing, is everybody should be doing monthly cyber awareness training for all their staff. It will protect you beyond belief. 2FA and cyber awareness training will knock out almost all these things. If we're getting back to the thing we're talking about, the question is, yes, from the retail broker side, where they put their money with their liquidity providers is incredibly important to them. They want to be really, really safe. So the sort of stuff that you're doing in there is incredibly important, and where they put their money with FX liquidity providers is similar. Now, if we go a level up to where I think it's all going in traditional finance with the big money, so the banks and the funds, where they've got enormous sums of money, where they will place it with a custodian, a regulated custodian. That's their level of comfort, and it's even higher. And at the moment, they are not comfortable putting money in the same place they trade. They want a separate custodian, so they want separation and segregation of responsibilities and duties. And I do think that will continue, because you've got this dichotomy of you've got the best technical way of doing things and the money driving it somewhere else. And I think the money always wins. So the TradFi people with all the money, and it's substantially larger than in crypto, unfortunately, will drag some of it away from the best technical solution, because it's better for them and they'll feel safer. So we'll end up with a sort of compromise. And what's happened in TradFi is you generally have a separate entity as the either clearing venue or the custody venue from where you actually do your execution. So I think that's the way it's going to go. It'll be interesting to see.
Now, almost 10 minutes. The main and the most interesting, from my perspective, questions: technology in the crypto and liquidity in the crypto. So, Tom, can you start a little bit, because you were one of the first when your product started offering a really good, reasonable, let's say, solution for crypto, for brokers to start really using and facilitate in general the crypto business. So what do you think is the most important things, let's say few points which is really important to know as if I want to use technology to enter in the crypto space?
So I think the concept of a prime of prime in FX is incredibly prevalent. A retail broker is very unlikely to open an account with a bank because they're just totally mismatched in size. But in the crypto world, you didn't really have that sort of concept. So I think the concept of the prime of prime, which we power quite a lot of companies with prime of prime crypto technology in our space. And so it makes it much easier for traditional finance to operate in, because they deposit in one place. The prime of prime does all the aggregation. They deal with Hidden Road if they're doing proper prime broking. They deal with all the settlements and all that sort of stuff. They take the risk away from it, and they simplify it to a single stream of prices that looks like something they're more familiar with. So I think the single thing I would say is that prime of prime, that middleman that makes the whole process simpler, because I think in finance, you have to match the right size. So you have the big fish, the middle fish, and the small fish. And I remember someone from, I think it was Binance years ago, telling me that Binance will own the entire crypto market. Institutional banks will deposit with them, and they will do all their trading with them. And the retail investor trading €1 will trade with them. It'll all be owned by that one exchange. And I said, I don't believe that's the case, because traditional finance does not like putting everything in one basket.
Yeah.
That was before CZ went to jail, so maybe slightly different.
But back to the technology.
Yeah, I mean, we've talked enough, I think, about liquidity. Let's say technology providers that we choose, I think we can divide them into many categories. We can divide the partner as a KYC AML provider, let's say. We can categorize it under, liquidity provider. We can, as Anton said, we partner with, smart contract auditing companies, to go through our proof of reserves, to go through our contracts to see how they work. Fiat on and off-ramp providers, all these are different tech providers that each exchange needs to scan the market and select from. So I think that there are some common characteristics that we want these providers to have. And I think number one is obviously track history and reputation. So we want to partner up with the best possible providers.
But do you think that the liquidity in general, and the technology and liquidity has changed a little in the past few years? Because a lot of market makers are around, a lot of OTC desks which start offering really specific rates or specific execution based on the size of the tickets and all these things, which were not really the case 5 years ago, where we were discussing constantly one of the main problems is the liquidity. One of the main I cannot execute some trades because there is no liquidity. Now I think this change, and with this liquidity, with this change for the liquidity, also technology start changing,
Yeah, I think liquidity is one of these tech categories, let's say we can place it that way. So what we do is obviously collaborate with quantitative trading firms that have this capability, like Kronos, I think, was the latest integration we had. And we also have liquidity incentive programs where anyone can apply, even like from a trading firm to up to down to an individual.
All these market makers.
Yeah,
okay,
exactly.
Yeah.
So I think the lower limit is 50K threshold and can go like up to millions. So this is how we tackle and embrace the liquidity challenges, and we have done it successfully until now. But yeah, getting back to the tech providers in general, we look at their reputation, their track history. We look at whether they can offer us global coverage. So, for example, can SamSap, which is our KYC provider, handle the onboarding of users worldwide, because we have like 120 million users in more than 200 countries. So we need partners who have this global coverage. We need partners who can offer us like easy user interface for the users. So that's also a thing. We need partners who have the appropriate licenses to operate in these regions. All right. So when we're talking about fee and on-ramp, off-ramp providers, we need these partners to have like the AMI license or whatever license they need to have in certain geographical restrictions to be able to offer these services and have an easy onboarding and fast onboarding. So it's a combination of things, I would say. So just to recap, it's like proof of history, track record, regulation, user interface, and global coverage. These are the things that we look mostly.
Yeah, my final question, again, back to this topic from a little bit different perspective, because we are now discussing that liquidity is changing. Obviously, technology must be changing, and we are discussing that crypto can be hedged, can be used for different ways, from the traditional finance to attract more clients, to offer some other products, to hedge themselves, to use as a payment methods, and many other things. But, for example, when I open a pure crypto exchange, let's say, I can see tiers like 10, 20, 100 tiers. I can easily see a lot of things, and I can trade and know the ticket size and everything. The traditional brokerage companies, from time to time, they cannot offer this because of their limitation in terms of platforms, or maybe because of the limitation from the liquidity side of things. Their liquidity providers are not sending all these tiers. Do you think that this is something which is changing? Because I can see some brokers are trying to achieve this, some technology providers are trying to let's say, to improve their technology to deliver exactly what is needed to be delivered to, these brokers to start offering really competitive services like the other guys.
Yeah, so I think that's the role of our sort of company. So
exactly,
our job is to connect everything together, but also to normalize everything so that it doesn't matter whether your liquidity is coming from a market maker, an ECN, an exchange, or where it's coming from. It looks the same way that your users want to see it. And some of that might be, if I'm connecting to a big crypto exchange and to get 10 Bitcoin, I've got to go down 40 levels of depth. We've got technology to dynamically compress an order book to go to different levels. So if your typical client is buying, 0.1 Bitcoin, you might have your first layer of depth as a VWAP price of 0.1 Bitcoin. So they're not going to get slipped much on the price they see. If they are trading on the top of the book and the top of the book is very thin, they think they're going to get slipped on everything because they're going down the book. So order book compression is really important. Another thing is dynamic throttling, which we do, because when you aggregate Bitcoin across multiple venues, the price updates come through at 20, 30,000 times a second. It can be literally enormous. And so the takers on the top end don't need that number of updates, and it just clogs the system up. So we have a dynamic scalability. So there's all sorts of things that we adapt and normalize to make it work further up the chain. And I think that's the sort of well, that's the value of someone like our type of company does, is to normalize these things so that you don't have to, single API, can access wherever you like, and it's all the pain's taken out.
All right, so as a conclusion, a lot of things are changing for the good, for the crypto in general. We can use in different, we can use Hedge as a different ways of, implementing, like from acquisition to different products to offering different services to payments or whatever. And especially coming the regulation, I think it's crypto is in a really good path in the traditional finance. Huh?
It's the most exciting thing that's happened in this market.
Thank you guys. Thank you for everybody for being here.
Yeah.